Hey traders, Jason here from the Web Brothers. So going to do an update of my State of the Market series, see how the market is going. Okay, we kind of know it went straight down. Tariff news came out, went straight down, and then it went straight up. It's made basically a full recovery. At least the NASDAQ and the S&P have made a full recovery. The small caps have not. So I just want to check out like what's going on right now. We made a nice recovery. We've paused for the last week and a half. I'm going to look at the indexes here, going to look at some breath readings, try and get an idea of like what's really going on, see if we could draw some conclusions. All right. So here is the S&P 500 weekly chart. As you can see, coming out of a base at the end of 2022, rallied up in 2023, a little bit of a pullback there. And then 2024 was a fantastic year. And then we got a high in February and we went straight down and now straight up. Okay. Hard to read it right here. Okay. You can see on the way up, the 21 EMA on the weekly chart was support. Now that orange line is like right over here. So it was like resistance there, resistance here. Now we're above it. I kind of consider this no man's land. Okay. We got the highs up here. We got a gap here. Some key moving averages down here at 5,700. Kind of to me looks like no man's land. I could see a move up here to the highs, maybe a little bit higher, but I think we need to flag a little bit more over here before we can really make a run higher. To have that kind of a run in such a short period of time, I think the market needs to gather itself. I think it needs to rest a little bit before it tries to run too much higher. It's just kind of I'm not using any indicators. I'm just kind of looking at the chart saying, nice recovery, needs to rest, maybe do a little bit of backing and filling, just pause for a little bit longer so it can restore some of its energy. Here is the daily chart going back a year. Okay, so obviously you can see, big, whoa. You can see big move down, counter move, and then just got crushed, move up, counter move, and then just rallied huge. Now I consider it to be somewhat in no man's land. And you know what? There's nothing wrong with this, okay? We had a debt downgrade. We had a bond offering last week that didn't go very well. We had tariff news. And what happened? The market fell a little bit. Okay, that's not that bad. I would consider that to be pretty good, and I consider the market to be pretty resilient right now, okay? If we got a debt downgrade somewhere over in here, the market would have gotten absolutely crushed. Okay, if we had a bond offering back here in March that didn't go very well, market would have got crushed. Okay, tariff news did crush the market. Okay, now we got all three of those in like 1 week, and what happened is the market just simply went down a little bit. Okay, that's pretty darn good. Okay, the market has built up some resiliency. It's built up an ability to absorb bad news. So I would say market's in pretty darn good shape, okay? Maybe it pulled back a little bit more. It's come down to its 21 here. Maybe we get a bounce, then it drops a little bit more and catches its 50-day moving average. I don't know, but bad news is no longer sending the market down like it used to, and that's a really good sign, okay? Just purely, don't look at indicators, don't look at anything else. Just the fact that the market has been able to hold up in the face of bad news is a really good sign, and it tells me that even if we get a little bit more selling here in the next week or so or whatever, it's got some good underlying strength, and we're going to go higher eventually. All right, let's look at some breath readings now. All right, so here is the S&P 500 up top versus the 5-day moving average of the NYSE AD line. As you can see, divergences like to call turns. So as the market was moving up here, higher highs, and we got lower highs here. Okay, classic negative divergence that plays out over the course of a couple weeks. Then the indicator fell, not deep, but it fell a decent amount into negative territory. And the market pulled back last week, okay? No big deal, okay? I don't see anything alarming here, okay? It's pretty normal. Like even when the market was over here, we got some weaker prints, okay? Eventually led to a top. But as of right now, I don't see anything that's like a major warning. Now, if the market moves back up here and this indicator fails to move up, too much, maybe it moves up to zero, maybe a little bit above zero, and it like fails to really expand, then we'll get a bigger warning. But right now, to me, this is like normal stuff, okay? Market moves up, this indicator expands, market moves up a little bit more, indicator softens, market moves up a little bit more, over here we can't match the high, negative divergence in place, now the market's got to fall, let out some air, etc., no big deal. Market can cycle down, restore some energy, stocks could rest, etc. It's like pretty much normal stuff here. Market doesn't just go straight up, so I don't see anything that's like a huge warning. Here is SP 500 up top with the NYSE AD line down below. As you can see, we had a pretty obvious negative divergence here when the market went new highs. We had the advanced decline line put in a lower high. Market then fell. Obviously, there was news involved. But even down here, like this low was obviously not as extreme as this. Market has bounced back. You can see the AD line broke out to a new high, came back. Now it's coming down to test the 21. 21's a guide. It's not a magic line. But overall, I'd say this is pretty darn good. Okay, this is the overall advanced decline line, and it's doing very, very well. And I just don't see any major warnings here. Now, if the market goes up again, goes up 6,000, 6,100, goes up and tests these highs, but the AD line kind of struggles here, maybe it moves up, maybe it moves sideways, that would be a little bit of a warning. But right now, the AD line is perfectly in sync with the market. It confirms the market strength. There are no warnings here. Last one with the AD line, this is like the breadth thrust indicator. It's the 10-day moving average of advancers versus total stocks. You can see at the high, as we're pushing higher highs here, we got lower highs over here. So negative divergence plays out over the course of a couple weeks, little by little. At first, it doesn't matter because the market is strong. It can be pulled higher by some really strong stocks, but eventually, beneath the surface weakness starts to come up to the surface, and it pulls the market down. So that's what we've gotten. A little bit of air let out last week. Not a big deal, okay? But again, if we get a bounce here, and this bounces but doesn't bounce too much, that'll be a warning, okay? But we'll wait and see. As of right now, I see no major warnings. This isn't telling us that this move off the low is over. It's just like normal stuff. It moved up. We got confirmation of the strength. Lots of stocks participating. We're getting some near-term softness right now. No big deal. As long as this expands, when the market bounces again, the market will be in good shape. All right, here is the 5-day high-low. Okay, it's like the all-stock 5-day high-low. You can draw a trend line here, which I'll get to in a second. But overall, so the market moves up here, and the 5-day high-low expands to one of its highest levels in several months. Market keeps going up. Get a high print here, but we got a lower print here, so it's a little bit of a warning. Obviously, we get a much higher print here and a lower print here relative to back there. So we get a negative divergence, and then the market falls off. And as you can see what happened, we get, the 5-day high-low drops well below 2,000. This is very normal stuff, okay? The first move up is kind of like, it's like a rocket ship getting escape velocity and getting out of the Earth's atmosphere. And then once it gets out into outer space, then it could glide higher, melt higher without a whole lot of resistance. But during that time, beneath the surface, less and less stocks are moving up. At first, it doesn't matter, but when you get a divergence that plays out over 2, 3, 4 weeks, eventually it matters, and then the market needs to come down and rest and cut some of the dead weight and restore some of its energy to get ready for the next move. Okay, it's perfectly normal to have a high print like here early in a move, and then the market could just melt up for several weeks. And that's exactly what's happened. So as long as this expands back up when the market bounces, the market should be just fine. Here's the same idea, but now we're dealing with the 1-month high-low. Okay, market moved up. We got 1-month high-low here. Negative divergence formed because the market moved up higher there, but lower high here. Market's now pulling back. It's normal stuff. It's perfectly fine. It tells you that we're going to have some near-term weakness, but it doesn't suggest or hint or scream that like the market's in trouble. Okay, it's normal stuff. As long as, when this thing bounces, as long as this immediately gets back above zero and then eventually expands, up much higher, the market should do just fine. Okay, next one. This is the Russell 3000 stocks above their 5-day moving average. Okay, so market moves up, let's say here, and we got like 85, 86, 87% of stocks are above their 5-day moving average. Market legs up again, a little bit less, but we still got like over 80%. Market moves up again, still over 80%. And then on the last little bit here, higher high, now it's only like 65, 66, 67%. So we get a negative divergence there on that last leg. I'll draw it cleanly here. Man, that's bad. So we got higher high here, lower high here, and obviously you can see it breaks down and goes, now we're down at like 13, 14%. Perfectly normal stuff. As long as this expands up when the market bounces, we should be fine. Okay, if we don't get much of an expansion, if it like hangs out down here and can't get up to a high level, that would be a warning. But as of right now, I don't see any warnings. Okay, everything looks good to me. It's normal stuff. The market is allowed to pull back. It's allowed to rest. It's not going to just go straight up. It expands quickly, then it digests the gains. This is normal stuff. All right, same thing, except we're dealing with the 20-day moving average. So Russell 3000 stocks above the 20-day moving average. And as you can see here, it hung out at a high level and then eventually broke down. You can consider this to be a little bit of a divergence. Whoops, I don't want that. You can see this a little bit of a divergence here where the market kept pressing higher, but the number of stocks above their 20-day moving average basically sat tight right under 80%. I don't consider it to be too much of a divergence because to me, like this is pretty good. You got, for an entire, 3, maybe even 4 weeks, you got the number of stocks trading above their 20 to be like between 70, 80%. That's like good, steady, consistent, broad-based participation. Then it fell off pretty hard last week, which is fine. Okay, it's perfectly fine. I don't see any warnings here. All right, last chart, SP 500 up top versus the 10-day moving average of the put-call ratio. A lot of bottoms in the put-call coincide with tops in the market. Okay, so we're getting one right now, so we have to be a little bit careful. Okay, you can see a bottom here coincided, not exactly with the top. We had one more higher high there, but even so, like bottom here, top here, bottom here. Top there was a little bit delayed. So we have to be aware of like near term, we're getting a bottom here and it moved up. So that as of right now coincided with the top there. All right. So overall, near term, there's been a little bit of a weakness. Okay. Breadth has come down. 80 line has come down. It's got, the 5-day moving average of the 80 line has come well below zero. Certain breadth readings have come down. Number of stocks above the moving average. Moving averages at the high, low, and various time frames. The put call here. So like a lot of things in the near term have like softened, which is perfectly fine. But overall, things still look good. And again, in a 1 week period, we had a debt downgrade. We had a bond offering that didn't go well. We had tariff news, and the market fell a little bit. Okay, which is perfectly fine. Okay, a month ago, the market would have gotten absolutely crushed. The fact that it only fell a little bit on all this bad news tells me the market is resilient and it wants to go higher, and it's probably going to go higher. So we definitely want to be leaning long. All right, so hope you got something out of this. You definitely don't want to be too bearish right now. You should be in the market to the long side. Build your list of stocks that you really want to buy and own for when the market bounces again. And honestly, like I'm bullish enough right now that I'm hoping for some more downside because I want to buy some stocks at lower prices. All right, we'll see you next time.